Last week, the Fed came out with a surprise announcement, totally dropped the mic with a big change in their policy. Actually, that's not what happened at all. I'll give you details coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Corhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. All right, so the Fed meets 8 times a year, all right, and they met last week and then released their statement that everyone was focused on. Are they going to raise rates? Are they going to change what they're doing? Are they going to start talking about tapering? What's the big announcement? And I mean, obviously, we've got inflation at its highest level in 30 years. We've printed more money than you can even fathom. We've got home prices at all-time highs. Lumber prices are coming back down, thankfully. But by and large, commodity prices are way up. Oil prices, gas prices are up to above pre-pandemic levels. We've got the most expensive used cars have ever been, ever, right? Stock market's at all-time high. I don't know if I said that yet. We've got all sorts of craziness going on. A lot of people have just been wondering, is the Fed going to change their position? Is the Fed going to make a change to their policy? Well, they did, sort of. Back in March, when the Fed was announcing their policy and the update, you know, we're sort of by March, vaccines and vaccinations were up, and we were starting to get the sense that, hey, we might be getting on the other side of this thing, at least economically, and even though there's a lot more pain still to come, but I mean, it seemed like things were getting better, and the Fed said, which was sort of a surprise to some, I thought it was pretty bold. The Fed basically said, listen, we need to get a lot further along in the recovery before we would change anything, okay? We are keeping interest rates at 0 through 2023, which they had originally been flip-flopping, but for 3 more years, because this, again, was beginning of 2021. We're going to keep interest rates at 0. We're going to continue to inject $120 billion a month into the economy, and we're not even going to start thinking about tapering that, which means, you know, starting to slow that asset purchase or injecting. When the Fed purchases an investment, that's them injecting money into the economy in exchange for a certificate. So they're not even going to start thinking about tapering that, and they're going to keep an extremely accommodative policy in there. That's what they said back in March. So what's happened since March? Investment speculation has been absolutely rampant. We've got AMC, a company that's lost money for, I think, each of the last 4 years, so this isn't just a pandemic thing, is now worth $30 billion. It's more than quadrupled. We've got all sorts of speculation happening with SPACs and with cryptocurrencies and with other meme stocks, okay? We've got commodity prices that have gone through the roof. Speaking of through the roof, housing prices have never been more expensive. It's never been more expensive to own a home versus renting a home. We've had lumber prices absolutely skyrocket, go up more than 4 times. They're since falling back down. We've got other commodity prices going up as well. Here's a few other kickers. We've got Greece bonds. Now, some of you say, why is this dude talking about Greece? Guys, just a few years ago, there was this whole insolvency issue with Greece and different areas of the Eurozone. They were basically bankrupt, and it was they had to do some austerity measures, and they are not out of the woods. Greece bonds are now negative, meaning there's no risk in owning Greek bonds. It's fine. Junk bonds, so high risk bonds, are at their lowest interest rate ever, meaning there isn't even enough, you know, those aren't even risky at all. Complacency is unbelievable. The stock market's at all-time highs, and yet we've got volatility, so the VIX is now below pre-pandemic levels. So since March, oh, by the way, it's never been more difficult for a business to hire an employee. We've got more job postings than ever before, and we've got the highest number of people quitting their jobs on record, right? Oh, and lastly, gosh, forgive me for mentioning that since March, we also printed more stimulus money and we proposed nearly $4 trillion of additional economic plans that are still in negotiation phase. And we have the largest fiscal deficit ever. The budget even includes some tax increases that aren't even looking like they're going to happen. And we still had, trillions and trillions of dollars in projected deficit. All that's happened since March, okay? All that's happened since March. And inflation was supposed to be transitory, and again, it came out at 5% year over year, which many are expecting. That's not transitory at all. So that's the stage. Hopefully that set the stage for you. So back then, the Fed said, hey, it's not, things aren't good enough yet. And then almost every measure came out saying things are explodingly good, if that's even an adjective. And so here we've got this crucial meeting and the Fed announcing what their policy is. So what'd they do? Drum roll, please. Big change. They said, we will likely raise rates twice by the end of 2023, moving the interest rate from 0 to likely 0.5, 0.6, something like that. Guys, that's nothing. That's nothing. That is nothing. That still means that if you are holding dollars at the bank or holding in short-term money market or short-term interest rate investments, you are earning a negative just about 4.5% per year in real returns. That is a head scratcher. Not that anyone, least of which myself, expected them to say, yeah, actually we're raising rates right now and we're going to have to raise rates significantly. But it's still like this isn't even a big headline. Everyone predicted this, that the Fed said, no, we're just going to keep printing $120 billion a month. There was no talk about tapering that at all, okay? We're going to keep doing that. And we might need to look at increasing interest rates a little bit, maybe before the end of 2023, but we'll have to be watching inflation. This is no surprise at all. There's no mic drop here. And to me, it says one of two things. Number one, it says the Fed says we are not worried about inflation at all. We don't think it'll be there. I understand it's now 5%, but that's nothing. It's going to come right back down. In fact, there were some charts that showed they believe inflation's doing this, boom, and coming right back down, okay? So that's one thing that this could say. Or it says the Fed is actually trying to create inflation and keep interest rates low so that investors or for interest rate holders, people that loan money, there's a negative real rate of return. They're trying to create inflation while keeping interest rates low so that folks that aren't taking big risks or folks that have debt, there's a negative return and debt is a lighter load. You decide which one. Do you think they're right and that inflation's just, it has spiked and it's going to come directly back down? That's what the bond market is saying, by the way. The bond market has not freaked out at all by this announcement. Or do you think the Fed is basically saying, nope, we're just going to keep interest rates low? I mean, they're going to meet another, 16, 20 times over the next 2.5 years? And they're only going to raise rates twice? I mean, you know how much can change in 2.5 years? And so to me, I think it's likely they are just trying to keep real interest rates negative, meaning they're going to keep inflation higher and only pay a little bit on interest rates to penalize folks that aren't taking risk and to make debt burdens feel a lot lighter. So what does this mean for you? I think the risk that the Fed makes a mistake or that the economy overheats, I think that risk is significant. I think that potentially could be a bigger risk than any other economic and stock market uncertainty right now, that the Fed makes a misstep. Therefore, make sure you're taking the right approach in your financial life, doing what's prudent, making sure that you're paying down debt, making sure that you're building an emergency fund, making sure you've got a solid budget, but also make sure you're investing wisely as well. This has been a challenging year thus far, or at least a couple months for momentum strategies. The market has had no momentum at all, but that's why you have a momentum strategy. and a diversified model as well that complement each other during times like this. So work with your CFP on that. We'll wait to see if the Fed makes any other changes. Who knows? Who knows? This is a very, very interesting time for central bankers and for the rest of us trying to interpret what in the world they're doing. So work with your CFP on that. See how it applies to you. If you don't have a CFP on your team, contact one on my team. Find us online, corehorn.com. That's Corehorn with a K. wisemoneyshow.com. You can find us there as well, or send us an email, info@corehorn.com. All right, there you have it. Go out and take your next wise step in your financial life.